Imagine opening your phone one morning and seeing that the small company you invested in just got valued at $50 million. Your tiny stake? Suddenly worth more than you made at your full-time job over the last 5 years. Sounds unreal, right? But here's the twist. That type of win does not come from buying random stocks. It comes from something most beginners think is only for millionaires: angel investing. And today, I am going to show you the best way to start angel investing, even if you are a complete beginner. But here's the part you want to stick around for. At the end of this video, I will reveal the one mistake that causes beginners to lose most of their money before they ever see a win. Stay with me, because once you understand this, you will look at investing in small companies differently for the rest of your life. Angel investing sounds exciting. It sounds powerful. It sounds like a secret door into wealth. But beginners usually ask the same question. How do I even start? Do I need a ton of money? Where do I find founders? How do I know which ideas are good? That is exactly what this video breaks down step by step in the simplest way possible. Number 1, understand what angel investing really is. Most people hear the word angel investor and imagine some billionaire writing checks with the gold pen. In reality, angel investors are simply individuals who put their own money into early-stage companies. That might be a brand new app, a new physical product, a tech tool, a local business with big potential. The goal is to invest early, take more risk, and potentially get a big reward if the company grows or gets bought. Think about someone who invested a few $1,000s into a tiny company called Uber back when it was just an idea with 2 cars. That early check turned into millions of dollars later. That is angel investing. But here's the truth beginners must understand. Angel investing is not like buying stocks. Stocks are companies already proven. Angel investments are newborns. They're young. They are untested. They could become giants or they could disappear. So you need to know exactly how to approach it the right way. Example: imagine your friend builds a new software tool for teachers. She needs $10,000 to launch. She offers you a small piece of her company in exchange for that investment. If the company succeeds, your small percentage could become life-changing money. Number 2, know if you need to be an accredited investor. This scares beginners. They think they need a huge income to start angel investing. Here's the good part. You do not always need to be an accredited investor anymore. An accredited investor is someone who earns at least $200,000 per year alone or $300,000 together with a spouse or has a net worth of at least $1 million. But thanks to recent rules, you can now invest in startups on certain platforms even if you do not meet those requirements. Platforms like Republic, WeFunder, and StartEngine allow everyday beginners to invest as little as $10 or $50. For example, a beginner could invest $50 in a company building a new fitness device. That tiny investment gives them real equity. So beginners finally have access. But here is the catch. Just because you can invest with low amounts does not mean you should invest in everything. That brings us to the next part. Number 3, start with what you understand. The biggest mistake beginners make is investing in ideas they cannot explain. If you cannot describe the business in one simple sentence, do not invest in it. Great angel investors follow a simple rule: invest in what you understand. For example, if you have worked in restaurants for years, you'll understand food tech ideas better than someone who works in finance. If you are a nurse, you may understand healthcare tools better than someone working in retail. When you invest in familiar industries, you recognize what problems are real and which ideas are nonsense. An example: imagine 2 companies come to you. One is building a new app for teachers that improves classroom communication. The other is building a complex blockchain solution for supply chain tracking. If you're a school teacher, the first company makes sense. You understand the pain, the workflow, and what teachers actually need. The second one, you might not even understand what they're talking about. So always start where you have a natural advantage. Number 4, learn where to find startups. Beginners often think they need to know Silicon Valley founders in order to invest. Not true. Today, you can find early-stage companies everywhere. Here are the easiest places to find startups as a beginner:
online investing platforms. Websites like Republic, WeFunder, StartEngine, and AngelList let beginners browse hundreds of startups. You can read pitch decks, financials, risk factors, and even founder bios. Local entrepreneurship events. Many cities host pitch nights where founders present ideas to local investors. Anyone can attend. Social media. Founders often post their early ideas on platforms like LinkedIn or Twitter. Your personal network. Some of the best investments come from people you already know. A coworker building an app, a family member launching a product, a friend testing a new software.
Example: a beginner might scroll through WeFunder and find a startup creating a new smart water bottle that tracks hydration. They can read the details and choose to invest $50. Another example: you attend a local entrepreneurship night. A founder presents a new landscaping robot. You love it. You decide to invest $1,000 for a tiny piece of their company. These opportunities are everywhere once you start looking. Number 5, learn how to evaluate a startup. This is the part that scares beginners, but it should not. You do not need to be a professional analyst to evaluate a startup. You just need to look at a few simple things. Here are the key ones. The problem. What problem is the startup solving? Is it a real problem people actually struggle with? The solution. Is the solution clear and useful? Does it make life easier, faster, or cheaper? The customers. Who will buy this? Are they already buying something similar? How big is the market? The product. Is there a working prototype, or is it just an idea? The founders. Are the founders experienced, passionate, coachable? Do they stick with problems or quit fast? The traction. Has the business already made sales? Do they have users? Example: imagine a startup building a new budgeting app. They show that more than 1,000 people use their free version. They have 500 paying users already. The founder has 10 years of experience in personal finance software. That is strong early traction. But imagine another startup building a budgeting app with no users, no revenue, and no experience. The idea might sound cool, but the risk is much higher. Number 6, understand how much money to invest. Angel investing is risky. That is why you should never put all your money into one company. Think of angel investing like planting seeds. Some seeds grow, most do not. The safest approach for beginners is to invest only a small portion of their investment budget. Many experts recommend investing no more than 10% of your total investing money into angel investments. And within that 10%, spread it across several companies, not just one. Example: if you have $10,000 saved for investing, you might use $1,000 for angel investments. You could invest $200 into 5 different startups. If one of them becomes successful, your returns could easily cover the others. Never invest money you cannot afford to lose. If losing the money would hurt your life, do not invest it. Number 7, learn how equity works. This part confuses beginners, so let's make it simple. When you invest in a startup, you usually get equity. Equity means ownership. If a startup grows or gets bought out, your equity becomes valuable. Example: if you invest $1,000 into a company valued at $1 million, your stake is 1/10 of 1%. If that company grows to $20 million, your $1,000 could become $20,000. If it grows to $100 million, that same stake becomes $100,000. That is how angel investing turns small investments into big returns. But if the company fails, that $1,000 becomes zero. That is why diversification matters. Number 8, know the different investment types. Angel investing does not always mean handing over money for equity. There are different ways deals are structured. The common ones are these: equity. You buy a percentage of the company. Convertible note. This is a loan that converts into equity later when the company raises more money. SAFE agreement. This stands for Simple Agreement for Future Equity.
It means you invest now and you get equity later during a future funding round. For example, a startup might say they are raising money through a SAFE agreement at a valuation cap of $5 million. That means your money converts to equity later based on that valuation. SAFE agreements are very common for beginner investors because they are simple and easier to understand. Number 9. Watch out for red flags. Every beginner needs to know the warning signs. If you see these, walk away. Founders who cannot explain their business clearly. Founders who avoid questions about money. Startups with no plan to get customers. Companies asking for too much money too early. Companies copying another business with no unique advantage. Example: imagine a startup says they need $5 million to build a simple app that already exists in 10 other versions, and they cannot explain why theirs is different. That is a major red flag. Number 10. Build a long-term mindset. Angel investing is not fast money, it is long-term money. It takes 5 to 10 years for a company to grow. Beginners often get impatient. They want quick results. But the biggest wins come from patience. For example, someone invested in Airbnb in the early days and waited almost 10 years before it exploded in value. But the return was life-changing. If they tried to cash out after 1 year, they would have missed everything. Angel investing works best when you are patient, strategic, and diversified. Number 11. Start small, but think big. Beginners often think small investments don't matter, but they do. Many early investors start with $100 and slowly grow. The goal is to learn the process, not rush. For example, a beginner invests $100 each into 10 companies over 2 years. Out of 10, 8 fail. 1 does okay. But 1 becomes huge. That one company could turn that $100 into $10,000 or more. This is why diversification is powerful. Number 12. The one mistake beginners must avoid.
This is the big one I warned you about at the start. The mistake that causes beginners to lose most of their money. They chase hype. A company becomes popular on social media, everyone is talking about it. People jump in without understanding what the company does. This leads to emotional investing, not smart investing. Example: imagine a startup gets viral for building a robot pet. Everyone on social media loves it, but the business has no real revenue, no manufacturing plan, and no experienced team. Beginners invest based on excitement. Those investments usually fail. But imagine a boring company building software for hospitals. No hype, no social buzz, but strong revenue and real customers. That is the better investment. But beginners miss it because they chase excitement. Do not follow hype. Follow real numbers, real traction, and real people. Number 13. Understand that you are betting on the founders, not just the idea. Beginners often fall in love with the idea. They forget that it is the founder who actually builds the company. A mediocre idea with a strong founder can win. A brilliant idea with a weak founder usually fails. When you evaluate a founder, look for resilience, look for obsession, look for someone who has lived the problem and understands the solution. If a founder quits at the first sign of trouble, the business is already over. Example: imagine a founder building a new mental health app. She has 10 years of experience as a therapist and already built a small community of users who love her approach. Compare that with someone who just thought about the idea last week and has no background in it. The first founder is the safer bet because she has real clarity and commitment. Number 14. Focus on startups with repeat customers. One of the easiest ways to reduce risk is to look for startups that have repeat customers. If customers come back again and again, the startup has something valuable. Repeat customers mean the product solves a real problem. It also means the business can scale and make steady revenue. Example: imagine a startup that sells a monthly meal prep kit. If customers renew every month, the business has strong loyalty. But imagine another startup selling a one-time novelty gadget.
Once someone buys it, they never need it again. Repeat revenue is what makes the first startup much safer. Number 15. Look for early proof that people want the product. Many beginners do not know what traction looks like. Traction simply means proof that people want the product. It does not have to be huge numbers. It can be small but real. Signs of traction might include waitlists, early paying customers, early partnerships, or strong engagement on the product. Example: a founder shows you that 200 people joined a waitlist in just 3 days after posting the idea on social media, or a software company shows they already have 50 paying users even before raising money. These signals matter. They reduce your risk. Number 16. Understand that not all startups need to be tech startups. When beginners hear the word startup, they imagine apps in Silicon Valley. But some of the most profitable early investments happen in real-world businesses. A new franchise model, a new medical device, a new home service platform, a new type of consumer product. Example: someone once invested a small amount into a company that created a simple silicone baking tool. It was not glamorous, it was not tech, but it got a distribution deal with a major retailer. That early investor made a strong return. Do not ignore simple ideas that solve real problems. Number 17. Focus on market size to understand growth potential. A great product in a tiny market stays tiny. A good product in a massive market can explode. Beginners often forget to check market size. Ask yourself, how many people want this? How much do they spend on this? Are more people going to need this over time? Example: a startup building a tool for remote workers has a larger market than a startup building a tool only for underwater welding specialists. Even if the second idea is clever, the first one has a much bigger growth path. Number 18. Study how the business will make money. A surprising number of startups have no clear revenue model. They talk about users, they talk about growth, but they do not explain how money will actually come in. You want to look for simple, clear revenue streams, something that you can explain to a fourth grader. Example: a company selling an online fitness program charges $10 per month. Easy to understand. Another company says they will make money someday through something complicated like government partnerships, licensing deals, and indirect advertising. Hard to understand, hard to trust. Always invest in companies you can explain clearly. Number 19. Ask yourself if this startup could survive without more funding. Many startups only survive because they keep raising money. If investors stop giving them cash, the company collapses. That is risky. Look for companies that can generate revenue early. Look for businesses that can operate with low costs. Look for founders who know how to stretch a dollar. Example: a startup building a luxury hardware device might need millions just to stay alive, but a startup building a simple software tool could make money from day one with tiny expenses. The second one is far safer for beginners. Number 20. Look for startups that already have a minimum viable product. A minimum viable product is the first working version of the product. It might be basic, but it works. If they have a product you can touch, click, or test, your risks goes down. Example: a founder building a new budgeting app shows you a working demo with real users testing it. Another founder says they will build the app once they receive money. The second one is riskier. A real product beats a promise every time. Number 21. Understand what makes the startup defensible. A defensible business is one that competitors cannot easily copy. Without defensibility, larger companies can crush the startup instantly. Defensibility can come from patents, brand loyalty, unique technology, partnerships, or early customer adoption. Example: a company building a new toothbrush is not very defensible. Anyone can copy it. But a company that develops a patented medical device for early disease detection is much harder to copy. That makes it safer long-term. Number 22. Learn how to make decisions without emotion. Beginners get attached to ideas. They get excited. They imagine huge returns. But angel investing requires calm thinking. You must separate excitement from evidence. Example, a founder gives an amazing pitch and you feel blown away. But when you look at their numbers, everything seems weak. If you invest based on emotion, you fall into the hype trap. If you invest based on data, you protect yourself. The best angel investors feel excited, but still evaluate the numbers with a cool head. Number 23. Track every startup you invest in. Many beginners forget to track their investments. They do not save documents. They do not record valuation. They do not follow updates. This makes it impossible to know what is working or not. Create a simple spreadsheet. Track the name of the company, the amount invested, the terms, the valuation, the updates you receive. Over time, this helps you understand patterns and make smarter decisions. Example, after a year, you might see that the 2 companies you invested in that had early revenue are growing. The 3 with no revenue are struggling. This type of insight helps you become a better angel investor. Number 24. Know that your network will improve your deal flow. Beginners often think they will never see good deals, but as you learn, as you join communities, and as you talk with founders, the deals will come. Being active on platforms like AngelList or attending local events helps you meet people. You will hear about opportunities before the general public. That gives you a major advantage. Example, you meet a founder at an event. Months later, she remembers your interest and gives you early access to her next fundraising round. Good deals come through relationships.
Angel investing is powerful. It can open doors to wealth that regular investing cannot match, but only when you do it the right way. Start with what you understand, start small, evaluate carefully, spread your risk, and stay patient. What type of startup would you personally feel confident investing in?